Hello everyone and welcome. Welcome back to our nonprofit auditor points, and I'm Irina Ryshkova, your nonprofit auditor. In a previous episode, we started a new series about policy that are important for a nonprofit organization. And we discussed why there is a need for written policy and why those policies should reflect how the organization operates, and why simply adopting the policy is not enough. We need to make sure that employees of the nonprofit follow the policy. Today we're going to start with one of the most important and probably one of the most familiar nonprofit governance policy. Again, it's a governance policy, it's not a management policy, a conflict of interest policy. Most nonprofits have heard of conflict of interest policies, and many nonprofits do have one. And every year, nonprofit, when they prepare their tax form 990, we specifically answer this question about whether the organization has a written conflict of interest policy. It is very critical, that policy, for the IRS purposes, that the IRS really encouraging every nonprofit to have one. And that policy should identify whether the certain individuals are required to disclose potential conflict annually, and how the organization reviews and handles such situations when the conflict exists. Again, having a policy is only part one of the issue. The more important question, whether the people understand and follow that policy. So let's start here. A conflict of interest generally arises when somebody has authority or influence over the organization, and the personal conflict could affect and appear to affect a decision that person makes on behalf of the organization. Sometimes conflict is very obvious. For example, imagine that one of the organization board members owns a construction company. A nonprofit needs to renovate its office, and the board is considering hiring the board member to perform that work. That's very obvious conflict of interest potentially can exist. The board member has a responsibility to a nonprofit, but in the same time, it has financial interest to its own company to receive the contract, so there is a conflict. But the conflict is not always a direct. Let's suppose the company owned by the member spouse, or perhaps the organization is considering entering a contract with a business in which the executive director has a significant ownership interest, so the conflict is not that obvious on the face. The financial benefits may be indirect, but there can be a conflict that needs to be disclosed anyway and need to be addressed. That's why a good conflict of interest policy should not simply say that the conflicts are prohibited. They're not prohibited. In fact, the existence of conflict does not necessarily mean that the organization cannot enter into that transaction. It is very important distinction. Sometimes a transaction involving a potential conflict may be actually reasonable and even beneficial for nonprofit. The purpose of the policy is to make sure that the conflict identified, disclosed, evaluated, and handled properly. Let's go back to our construction example. Suppose the board member company specializes in exactly the type of renovation your nonprofit needs. Maybe the company offers a competitive price and has excellent qualifications. The fact that the board member owns the company does not automatically answer whether the organization should or should not use that company. But the organization should not treat the transactions as though the relationship does not exist. The board member should disclose that interest. The appropriate individuals within the board needs to evaluate the transactions, and the interested board member who owns the company should not participate in that decision when nonprofit will decide whether to use this company or not. And the organization should document that decision, and that decision needs to be preserved for future. For California public benefit corporation, transactions involving direct material financial interest can also raise a specific self-dealing issue under California law. So the organization should recognize that and understand the conflict of interest can be more than simply an internal governance concern. This brings us to the most important parts of the conflict interest policy is disclosure. The organization cannot properly address a conflict if nobody knows about it. The policy should identify who is covered by that policy, meaning who is interested parties, and require those individuals to disclose their interests or relationship that could create a conflict. Many organizations that includes directors, officers, trustees, key employees, potentially maybe other employees have a significant authority over the organization decisions. Those are interested parties that can be covered by the policy. One common practice is to use an annual conflict of interest disclosure questionnaire. So every interested party receives the questionnaire and completes it. If they have any relevant financial interest, if there's any business relationships, family relationship, or other affiliations that potentially can create a conflict. Form 990 specifically asks whether officers, directors, trustees, and key employees are required to disclose or update this type of information annually, or sometimes more frequently. But the annual questionnaire should not be treated as the only time when someone has to disclose their conflict. Imagine the board member complete the annual questionnaire in January, beginning of the year, and has nothing to report. 6 months later, the board member's spouse starts working for a company, and that is negotiating significant contract with a nonprofit. The board member should not wait until the next January to update the questionnaire. The potential conflict should be disclosed as soon as it arises. So it has to be responsibility of the interested party to disclose that information. That's why a good policy should address both periodic disclosures and the new conflicts that arises during the year. Once potential conflict has been disclosed, the next question is what happened with it. So now nonprofit knows and what should happen. And that's where most mistakes occur. Disclosure by itself, it's not necessarily resolves the conflict. Somebody needs to determine whether the actual conflict exists and how the organization should handle it. Depending on circumstances, the interested person may need to leave the discussion, remove themselves completely, while the remaining board members consider the transaction. The person should generally not vote on that matter. Interested parties should not be involved in decision making. The organization should maintain documentation showing what was disclosed, how the matter was considered, and what decision was made. Board minutes become particularly important here. If the board member disclosed its financial interest, left the discussion, did not participate in the vote, the minutes should clearly reflect that. Years later, somebody reviewing the transaction should not simply rely on somebody's memory, what happened back then, if the same board member is still present. The organization should tell the full story, what happened. From the audit perspective, conflict of interest often becomes relevant when we as the auditors encounter transactions involving board members, officers, key employees, family members, business connections to those individuals. We as the auditors inquire about related party transactions every year when we do audit, when we engage in assurance services. And we do disclose such transaction in the audit reports in the footnotes. For example, we may see rent pay to a company owned by the board member. We may see professional services provided by a relative of an officer, or perhaps the organization purchasing goods from the business connected to someone involved in the governance. The existence of relationship does not automatically mean that something improper occurred, but it raises some questions. Was the relationship disclosed? Was the transaction properly approved? Was the interested person included in discussions and decision making? Was the transaction reasonable in the organization's best interest? And was the process properly documented and document retained? Those questions are often more important than simply asking whether the organization has a conflict of interest policy on file. That means nothing. There is also Form 990 reporting aspect. As I mentioned earlier, in the Part 6 of Form 990, there is a question where we're asking whether the organization has a written conflict of interest policy at the end of the tax year that tax return is filed for. It also asks about annual disclosures and how the organization regularly and consistently reviews and enforces the compliance of the policy. If the organization says that it does review and enforce the policy, its practices described in a separate section of the Form 990, it's a section O. There is an important point here. Form 990 governance questions are generally not saying that the federal tax law require every nonprofit to adopt every policy listed on a return. The IRS explains that these governance questions are intended to provide information about how the organization operates and to promote tax compliance. But if the organization answers that it has a conflict of interest policy, that policy should actually exist, should apply to the organization, and should have been properly adopted and followed. And if the organization says that annual disclosure is required, those disclosures should be actually obtained. This may sound obvious, but in practice, sometimes the organization has a conflict of interest policy, but not collect annual disclosure for forms from board members for several years. Or the forms are collected, but nobody reviews them and follow up on them. Or nobody discloses relationship. And again, the objective is not simply have a document. The objective to identify and properly manage the conflicts. Another mistake is assuming that every relationship is automatically conflict. No, but if you are in doubt, if the interest person is in doubt, it's better to disclose the relationship, and then through the process, the board may decide it's not a conflict. For example, two individuals may serve together on a board of two different nonprofit organizations. That fact alone does not necessarily create a type of financial conflict that should be contemplated and included in the Form 990. The IRS specifically distinguishes competing duties between the organization from the conflict involving a material financial interest and benefits. So if there is no material financial benefit, there is no conflict. So the organization needs to consider the actual facts and circumstances rather than simply label a conflict of interest. In the same time, organization should not define conflict so narrowly that obvious indirect interest is ignored. Family relationship and significant business interests can matter. The purpose is transparency. People making decisions for nonprofit organization should be acting in the best interest of the organization rather than using their positions to obtain undisclosed personal financial benefits. This concept is closely related to the board member's duty of loyalty. Every board member owns the duty of loyalty on the first place to the organization. California Attorney General described that duty as requiring directors to act with undivided loyalty to the nonprofit rather than seeking personal benefits or for themselves or their families. So before we finish today, let's summarize. A conflict of interest policy should help the organization identify situations in which someone involved in decision making may have a personal financial interest. It should identify who is covered by policy. It should establish expectation for disclosure, including disclosures when the new conflict arises. It should establish how conflicts are evaluated, handled, including appropriate restrictions on the interested person's participation in the decision-making process. Mostly important, the policy needs to work in practice, not only be established in writing. Having everyone sign an annual disclosure form and then putting those forms into folder, it's not enough if disclosed conflicts are never reviewed and addressed. The objective is to protect the integrity of the organization's decision-making process and make sure the organization decisions are made in a nonprofit's best interests. That's the reason for that policy to exist. In the next episode, we will continue our policy series with another important governance area. Again, it's a governance area, and it's the whistleblower and complaint reporting policy. We will discuss how the organization provides a way for the employees, volunteers, and others within the organization raise concerns, how those concerns should be handled, and why protection against retaliation is very important in that policy. Thank you so much for being here with me today. Appreciate the support. Be safe and looking forward to see you next time. Have a wonderful day.